our previous module, we learned about what is a tax, who can impose taxes on us, and how the tax code is enforced. In the second module, we're going to examine the principles of individual taxation. And in this chapter, we start with the individual tax formula. The individual tax formula is all driven by the filing status. So we'll begin by looking at that. Once we look at the filing status, we'll begin to look at how the filing status impacts tax liability, impacts the deduction, and look at calculating taxable income as well as tax on ordinary income. Let's get started. The individual taxpayer filing status is driven based upon a person's marital status and their family situation. That is, whether they have kids or other dependents who require on their income. This status is really the driver of most of the tax decisions. It determines the rate schedule for computation of tax liability. It determines the deductions that are allowed, as well as the eligibility for certain benefits. To illustrate the filing status and how it applies to different classes of taxpayers, we're going to look at the different characters from Friends, the popular 90s TV show. The first status is married. A person can be married and file jointly or file separately. The second is head of household, which refers to an adult who is unmarried but has care of a dependent or other qualified relative. And we'll define both qualified relative and dependent in a little bit. And finally, single, which is an unmarried person without head of household requirements. Let's look at what the tax code means by a married person. There are two separate statuses, married filing jointly and married filing separately. When you file jointly, you combine your household income and pay tax on the combined income. For this, the deductions are doubled. When you're married filing separately, you shield one person's income from the other. For example, if Monica's income was lower than Chandler's and combined they paid more taxes than they would separately, it would be advantageous for them to file two separate returns. The deductions are generally half for married filing separately, as they would be for married filing jointly. An important distinction about married filing jointly is the concept of joint and several liability. That means that if both spouses sign the tax return, both spouses can be held liable for paying the tax. If the person who is responsible for writing the check does not, the IRS will surely come after the second person. Finally, if a married couple loses their spouse during the tax year, the surviving spouse can claim married for the year that their spouse died. If the surviving spouse has a dependent child or a qualified relative, they can claim this status for 2 years after the spouse passes away. This allows for them to take advantage of the tax status that would have been had the spouse not passed away. There's also two classes of married persons. Single, which is an unmarried person who is not a surviving spouse and does not have dependents. And head of household, which is an unmarried person who is not a surviving spouse and has dependents. So let's check your understanding of the four classes of filing status: married filing jointly, married filing separately, single, and head of household. What would be Ross's filing status on the last day of the fiscal year if Ross and Rachel have been living together and they are married? Ross and Rachel, if they were married, would file either married jointly or married separately. If they're married, they get to take advantage of that tax status. Ross married Emily in May, but they divorced in October. What would be Ross's filing status? If Ross was divorced as of 12/31/2000XX and Ross was not the surviving spouse, his filing status would be single. Finally, if Ross was unmarried and assumes full custody of Emma, a minor, when Rachel moves to Paris, what would be Ross's filing status? If Ross had primary custody of Emma, he would be able to file as head of household, provided Emma met certain requirements as a dependent. So let's get into those requirements. In order to be a qualifying dependent, you can be one of two things, a qualifying child or a qualifying relative. So let's look at Emma from that last example. A child is a qualifying child if they're a child or specific family member who lives with the taxpayer more than 50% of the time, is younger than the taxpayer, is below age 19 if they are not a college student, and younger than 24 if they are a college student, and if they did not file a joint return. An exclusion exists if the qualifying child did file a joint return with their spouse, but only to collect a refund. As long as the child did not file a joint return and owe a liability, a parent or guardian can claim them on their tax return. So this means that either way, if Ross has primary custody of Ben or Emma, he can claim them as a qualifying child and earn head of household status. If Rachel or if Susan has primary custody of the child, Ross cannot claim them as a dependent on his return. But Ross may be able to claim a qualifying relative on his return. A qualifying relative is a member of the taxpayer's family or stepfamily who does not qualify as a dependent child, but who resides with the taxpayer, who is dependent upon the taxpayer for more than 50% of their support, and whose gross income does not exceed $4,150. So let's look at Ross's parents and his sister. Monica was married, so we can assume that Chandler is going to claim care for her if something tragic were to happen. However, if either of Ross's parents were to move in with him, and Ross were to assume primary care of them, and they met the income requirement, he could claim them as a qualifying relative and claim head of household status on his return. So now let's check your comprehension of the dependent status versus the qualifying child status under each of the following scenarios. First, Ben, age 24, is a college student. He lists Ross's Manhattan apartment as his permanent residence. Ross provides 80% of Ben's support, and Ben earns $6,500 during a summer internship. Can Ross claim him as a dependent child? The answer is yes, he can, because Ben is 24 and a college student. If Ben were not a college student, Ross could not claim him. But because Ross provides 80% of his support and Ben is a college student, he can claim him as his dependent child. Because he is a dependent child, there is no correlating income requirement. So if Monica suffered a debilitating accident and Ross provides 100% of the funding for her stay in the rehabilitation facility, can Ross claim her as a dependent or a qualifying relative? The answer is yes. If Chandler is completely out of the picture and Ross provides 100% of the funding for her stay in the rehab facility, she's not earning income, so Ross can claim her as a qualifying relative. And for whatever year the accident occurred, and until Monica gets out of the rehabilitation facility, Ross can claim her as a qualifying relative. Finally, Emma, age 20, dropped out of college and is now living with Ross. Ross provides 60% of Emma's financial support, and she pays for her remaining expenses through her part-time job. Can Ross claim her as a dependent or as a qualifying relative? The answer is no, alas. Emma has aged out of being able to be claimed as a dependent because she's dropped out of college. Ross does provide more than 60% of Emma's financial support, but without knowing what Emma earns for her part-time job, we can't determine whether or not he can claim her as a qualifying relative. If 40% of Emma's financial support is less than $4,150, Ross can claim her as a qualifying relative. However, the tax law hinges on conservatism. If you don't know the information, err on the side of caution, which means Ross can't claim Emma as a dependent. Now that we understand the different filing statuses, we can begin to compute taxable income. This is a four-step process. First, calculate total income from all recognized sources. We're going to look at, in subsequent chapters, what comprises income from investment, as well as what comprises other income. Step 2 is calculate the adjusted gross income, which is the total income less specifically excluded sources of income. In chapters 15, 16, and 17, we'll examine some of these exclusions. Step 3, subtract the standardized or the itemized deduction, whichever is greater. And step 4, if applicable, subtract the Section 199A deduction for pass-through profits. We'll briefly look at step 4 when we consider pass-through entities and sole proprietorships in chapter 10. In step 3, we deduct the standardized or the itemized deduction. The standardized deduction is specified by law, and the amount of that deduction is driven strictly by filing status. Married filing jointly, married filing separately, head of household, and single. In addition, those persons who are blind and those persons who are older than 65 during the calendar year in which the tax is being filed receive a higher standardized deduction, $1,500 for each of those two conditions. Dependents receive a partial deduction limited to their full income or $1,050. The itemized deduction allows a taxpayer to deduct certain expenditures that would otherwise not be excludable from the calculation of adjusted gross income. The itemized deduction is only advantageous to the shareholder or the taxpayer if the itemized deduction is greater than the standardized deduction. Another catch is that you can only take the standardized deduction or the itemized deduction. For example, interest on student loans is a deductible expense if you itemize. However, if your standardized deduction exceeds your itemized deduction, you can't take both. It's to your advantage to take the standardized deduction, but you can't do anything with this other deduction. The tax rates are also determined based on the individual's filing status. This gets into that concept of horizontal equity that we discussed in chapter 2. A person's ability to pay is a driver of how much they pay. In addition, there's several key terms that you should keep in mind for tax rates. To encourage investment in capital assets, capital gains are taxed at a lower standardized rate. and we'll talk about this concept more in Chapter 15, Part 2. The marginal tax rate is the rate paid on the next dollar of income received, i.e. your tax bracket. And finally, the kiddie tax is another special tax rate. This is the tax rate that occurs when a child receives income from an estate or trust. Because their income is so high, they get taxed at a higher rate because of the limitation in their standardized deduction. Now that we understand the individual filing statuses, as well as the income tax calculation formula, we can begin to apply this by looking at that marriage penalty I mentioned earlier. And to examine this, we're going to look at the income of Ross Geller and Emily Waltham, who were briefly married. Let's assume that they were actually married long enough to file an income tax return, and that they had no other income and can't itemize. What would be their combined tax if they chose to file separate returns? To compute our taxable income, as well as the tax liability, we need two things. We need to know the standardized deduction, and we need to know what tax bracket each of them fall under. But luckily for us, the standardized deduction and the tax brackets are both set by law. So once we know their filing status, married filing separately, we can determine their standardized deduction. And once we know their standardized deduction, we can determine their AGI. And once we know their AGI, we can determine their tax bracket and their tax liability. So if Ross makes $89,000 and Emily makes just over $40,000, and they file separate returns, they're both entitled to a deduction of $12,000. This leaves Ross with an AGI of $77,000 and Emily with an AGI of $28,330. This puts Ross in the 22% tax bracket, and it puts Emily in the 12% tax bracket. Since we know their AGI and we know their tax bracket, we can compute their tax liability. For Ross, it's the tax base of $44.53 plus 22% of the difference between Ross's AGI and the taxable base. Same thing with Emily. We have the taxable base plus 12% of her AGI minus the taxable base. This leaves them with an income tax liability combined of $16,089. Now let's compare that number that we just computed for Ross and Emily filing separately with the tax liability that they would owe if they elected to file jointly. Instead of Ross earning $89,000 and Emily earning $40,000, their combined income would be $129,000 plus some change. They'd still be eligible to the standardized deduction and the standardized deduction alone, since neither one of them can itemize anything. But since they're married filing jointly, this deduction is $24,000, which means that combined, Ross and Emily's adjusted gross income is $103,330. Now, let's look at their taxable rates. This would put Emily and Ross in the 22% tax bracket, which is the same marginal tax bracket as Ross fell under. However, the bucket of excluded income is much higher here, which means that a smaller portion of this is taxed at this higher rate. Overall, if Ross and Emily were to file jointly, they'd pay about $1,000 less income taxes than if they elected to file independently. The marriage penalty really only impacts those couples that fall under the highest income echelon. So now, let's make it a little bit more complicated. Assume for the current tax year that Ross has full care of Ben and Emma, who both qualify as dependents. During the taxable year, Ross had the following income and deductions: salary, interest income, capital gains, and itemized deductions. What is Ross's income tax before figuring in the child care credits? The first thing we need to do is to determine how the tax code treats each of these items. We'll discuss interest income and capital gains in chapters 15 and 16, but for now, we know that capital gains are not taxable, so we can exclude them from our calculation altogether. And we can assume that this interest income constitutes normal income. So Ross has a total income, adjusted income, of, which means that Ross has an adjusted gross income of $108,700. We know that Ross has itemized deductions totaling $34,000. Now, when can Ross take the itemized deduction? Ross can take the itemized deduction when it's greater than his standardized deduction. And if Ross has full care of Ben and Emma, he can qualify as head of household. The itemized deduction of $34,000 is greater than the standardized deduction of $18,000. So Ross should itemize Hence, Ross's taxable income after subtracting his itemized deduction is $74,700. We then refer to the tax table for head of household and look up where Ross's marginal income falls. Ross falls into the 22% bracket. Which means he pays tax of, and in the 22% income bracket, Ross pays a base tax of $5,944 plus 22% of what's left over, or $7,800. This puts Ross's income tax before credits at $13,744. Now, why do we bring up credits? Because certain credits entitle people to a discount on their taxes. However, each of the credits that we're going to discuss has an income phase-out amount, which means if you make above a certain income threshold, you're not eligible to receive the tax credit. In the previous problem, Ross had two dependent children, Ben and Emily, and we can assume that since he can claim them as dependents, they're young enough that he can take advantage potentially of some of these things. The applicable tax credits that we'll talk about are the child credit, wherein the taxpayer gets $2,000 for qualified child dependents below the age of 17. This means that for Ross's two kids, Ben and Emily, he could take a total of $2,000 each, or $4,000. The dependent care credit allows working parents to a credit of $3,000 for a single dependent or $6,000 for multiple dependents. This allows them to offset the daycare costs that may be necessary to work. And finally, the earned income credit is a refundable income tax credit that offsets the impact of the payroll tax on low-income workers. What I mean by refundable is the fact that most credits just offset the extent of income. You can take the credit, but it can only maximize out the income that you've earned. With the earned income credit, this can effectively give you a negative income, meaning that you'll get an even greater refund. In this unit, we talked about the taxpayer filing status and how the taxpayer filing status is used to calculate the standardized deduction and calculate adjusted gross income. In the next unit, we'll start to look at the pass-through income that's earned by proprietors, as well as the tax treatment of certain personal income and expense items.